Welcome back to Unearned Revenues and Accruals. We're continuing on that theme of adjusting entries. Just recall that we've been doing prepaid adjustments, unearned revenues, and we'll also look at the different bases of accounting. Now we're going to these unearned revenues and accruals. So let's continue. What exactly are unearned revenues? Well, they're revenues received in cash, but you haven't yet earned or done the work for them. For example, when a university collects tuition from students, they collect it in September, but they can't actually realize it or recognize it until the work has been done, until the classes have been done, marks done, things like that. Examples: purchasing a ticket for an airline. You purchase a ticket, you haven't gone anywhere yet, and so you're pre-purchasing that. But for the airline, it's an unearned revenue. Universities, tuition, and colleges accepting tuition before the classes start are both examples of unearned revenues. So let's jump right in. Here's an example. On May 1st, a construction business receives $10,000 to renovate a business. The renovations start June 1st and will last until the end of the month. Journalize all entries related to this contract. And we assume that we are using monthly interim periods. Again, interim meaning less than 1 year. So how exactly would we do this? Well, let's just pause the video, see if you could try and work through this. Again, try 2 to 5 minutes on your own, see if you can get this done. So May 1st, contract businesses receives $10,000. Definitely we need to have some sort of an entry because cash has been accepted. So we know that bank is going up, which means bank gets debited, but what exactly are we going to credit? We can't credit the revenue yet because the job hasn't been done. So we need another account. What is it going to be? It will be, drum roll, unearned revenue. All right, so there's our first entry that will go in. Cash 10,000, unearned revenue. But then at the end of the month, which would be, not the end of the month. Renovations start June 1st and will last until the end of the month, which means June 30th. So at the end of June 30th, we now can recognize or realize the profit that we've made or the revenue that we've made. In this case, we now have to debit our unearned revenue because we can realize that we've actually done it. We did the work for it. We should get paid. And we end up crediting our revenue account. All right, so we adjust. So cash was accepted earlier, and then we did the work, and now we do the adjustment a little bit later on just to show that the work has been done. And we don't do this until later because for all we know, what could have happened is we get the cash and then maybe the client pulls out and they said, okay, well, we're not doing the job anymore and you have to give the money back. So we don't recognize any revenue until the job is done. Accrued. Accrued is an accumulation or buildup. You could think of like water dripping down from a gutter and it's building up, an icicle. And accrued revenue, well, revenues earned but not yet received in cash or recorded at the statement date. And then there's accrued expenses, which they are incurred, meaning they happened, and but you just haven't paid for them yet or recorded at the statement date. So let's go on with this idea. We've got another example. We're jumping right into a second one. Pause the video at this point, give this a read through, and try and do it on your own. Again, no entry for the contract creation, so just keep that in mind. So let's take a look. On May 1st, a contract is signed to renovate a basement during June for our Adares. In June, the renovations are completed. Payment for the renovation is received July 15th. All right, so it says right here, there's no contract to be signed. Well, how exactly do we do this? I mean, no money is exchanged. Payment for the renovations is received July 15th and in June. So they did the work and then they get paid afterwards. So how exactly do we do this? Well, we should be recognizing the revenue at the end of June because we've done the work. So there's going to be some sort of credit to our revenue account. But what exactly are we debiting? Well, it's going to be the accounts receivable because we expect to get paid. And then we're going to need to make an adjusting entry in July for when the money is actually received. And that will be bank goes up, meaning debited, and our accounts receivable goes down. Let's take a look. So accounts receivable are Adares 10,000. So the job was done. That's a June. Hey, I don't think it's supposed to be June 31st. I think it's supposed to be June 30th. Ta-da! And with video editing, this is now paused and we get to change this to June 30th. Okay, that's right. So our accounts receivable goes to our DARES, revenue gets credited 10,000, and then we actually get cash. And depending upon what you're working with, usually this will either be called cash or bank. These days, I think a lot of people work with bank. And so our bank gets debited 10,000 and we adjust for money that we've received, and this is accounts receivable, so it goes back down or gets credited. All right. So here's another example, jumping right in, practicing what exactly we're learning here. This is about an accrued expense example. An employee salaries for Monday to Friday work week total $8,000 with a pay period starting September 23rd, 2013, ending October 6th, and have a pay date of October 13th. Prepare all journal entries related to paying the employees, assuming a monthly accounting period. And this is the key. That is a monthly accounting period, which means you're closing the books on September 30th. So we need to make sure that our accounting is accurate for September. Again, I would encourage you to pause at this point. The calendar here is for visual reference and should help you along with this. Having taken a chance or a crack at this on your own, let's take a look how we would do this. Well, let's just highlight first what days we're talking about. We've got 10 days, so it's a bi-weekly payment, and technically in September there are 1, 2, 3, 4, 5, 6 different days here that we should be accounting for. So instead of doing the full 8,000, we should be doing 6 out of the 10, which works out to $4,800. Well, what accounts are we going to actually debit and credit? Well, in this case, it's going to be an accounts payable. There's one. And, well, it's going to be some sort of an expense account for the debit. So salaries expense probably. And then once October 13th hits, we're going to have some compound entry that will reverse essentially what we've done here, while at the same time expensing the rest of the salary. So that'll be 1, 2, 3, 4. 4 days of this would end up being 4 out of 10 times 8,000, which would be 3,200. So we would have salaries expense in October for 3,200, and then we'll do the reversal on the first entry. So let's take a look at this. Salaries expense, there's our 4,800. Our salaries payable, we haven't paid them yet, but we need to pay them, and we need to close the books on September 30th. So this is the stuff that goes on for the adjustments. Now October 13th comes around, and then we need to actually pay people, but the salaries expense isn't all attributed to October, it's partly attributed to September. So one, salaries expense, like we said, were the 4 days in October, which is the 3,200. Our salaries payable, which was from September, 4,800. Those both add to 8,000. So good thing. Double entry system of accounting makes sure that for each entry, our debits are equal to our credits. And of course, we're actually paying people, so we end up having a credit to bank account. All right, moving on. We've got interest, and yeah, interest comes on loans. There's $100,000 that was borrowed September 1st, 2013 on a 5-year term from the bank with an annual interest rate of 5%, where the interest is paid yearly. Complete the journal entries that occur if the accounting period ends September 30th, or, so case number 2, or if it were to end December 31st. I'd encourage you to pause and try and do this on your own. Just see if you can get this. The very first thing I see whenever I do this is I'm going to start to think about the numbers. So what exactly are my numbers going to be? Well, here's what I do know. I know that we've got 5 years and we're working with roughly months here. And we are going to need to figure out how much we need to pay per month in interest. So 100,000 times 5%. And well, how much is it per month? Well, in 5 years, there's 60 months. So we're going to be dividing that by 60. Okay, so there's our 100,000 times 5%. So every single month, the interest is $416.67. Now, if we're finishing this off September 30th, well, then that's the amount that we're using. But if we're going to be doing this based upon a December 31st, then we'd have September, October, November, December. It would be 4 months of interest. And in this case, our yearly interest would be 4 times this amount, or 4 out of 12 times 5% times 100,000. So now where do we go with this? Well, we've got an interest expense that will probably come in here, And well, what else? I mean, we're going to have accounts payable. It really does depend on when we're paying that interest. Now, of course, we've got interest expense, which is here. There's our 416. It hasn't been paid yet. And our interest payable is 416. And again, with the same situation down here, money hasn't gone out until 1 year from the start of the contract. So the very first payment should be August 30th of 2014 before payments actually happen, and so there is no effect to bank in this situation, just the differences in amount. Now again, emphasize that these are two different cases, that these are not coming from the same one. So this one assumes that we're closing the books here each month, and this one down here assumes that we're closing the books at the end of the year, December 31st. So two different situations with two different interim periods. And that's it for this class. Hope you've enjoyed. If you've got any questions, reach out to me, and enjoy for now.